We are excited. We are excited. We've got Alon Hillel-Tuch here with us. Did I say that right, Alon?
Alon is
Alon.
perfect.
Alon Hillel-Tuch?
Yes, you got
Okay.
it.
Thank you. We're thrilled to have you as a guest. Alon is the founder of RocketHub, one of the most successful crowdfunding sites ever in history. He's an expert on venture capital, and he is a big deal. He has been on the board of the Crowdfunding Professional Association for forever, as long as the association has existed. I'm a newbie on the board. I'm honored to be hosting the discussion today, but let me encourage you to check out the Crowdfunding Professional Association online. We'd love to have you as a member. Please join us. In any case, Alon, let me turn the time over to you for this really important, exciting, interesting discussion about crowdfunding and venture capital. I think especially the dynamic and the tug of war between regulation CF, Reg CF, crowdfunding, and venture capital. So take it away.
Sure. No, thanks so much, Devin. What I'll do is I'm going to just share my screen since I prepared some slides for everyone. It's just going to make life a little bit easier for us all to go through. So look, the interesting thing, just to give you a little bit of background on myself, is as Devin put it, I started off as a co-founder at RocketHub back when crowdfunding was still a emerging concept. When that company got acquired a couple of years ago, I've since transformed the work I do into the venture capital space, identifying new companies and really figuring out how to invest into them. And one of the things that we've seen, as well as other people in my space, is this increase of companies having multiple sources of capital, multiple ways to raise funds. And one of them obviously is crowdfunding. But, one of the things that might be important to do is to get first a sense of what are we talking about here. So what I wanted to do is just address very briefly the kind of topics I want to touch on in this 30-minute session. Really, the conversation is going to be around how do you run a campaign alongside traditional venture capital, and I'll be able to give you the perspective of how a more traditional venture capitalist might look at it, but I'll also let you know about some of the viewpoints that, let's say, an equity platform that does crowdfunding look at it, or a perks-based platform. And I want to highlight some of the risks and benefits so that for those of you who are interested in this space, you're going to get a little bit of a sense of the choices you can make, the options you have, and the benefits and risks that are alongside every option. There is no clear answer in regards to this situation. That's because this is very much a emerging ecosystem. So, it's really, really important to kind of stay up to speed. Resources like the CfPA are a great place to go to see what is going on as things are emerging. So I recommend, besides this topic, to try to keep yourself up to speed on what's happening. So to really look at this, let's first work with some very simple definitions of what is venture capital and what is crowdfunding. Venture capital, to be honest, is just a type of capital financing. Usually the people putting in the money have a long-term growth perspective, looking at new emerging early stage firms, while crowdfunding is using small amounts of money from many people to fund a person, an idea, a movement, or a business, right? So just let's keep that in mind. So once we know that, the next question really becomes, why do people give? And this is where this is critical, because regardless of venture capital or a loan issued out by a bank or crowdfunding, there's these main reasons to why people give. And this holds true across all industries. They believe in the person, they know you or they know of you, they believe in the idea that you have and what you're trying to accomplish. They believe, for example, in the movement that you're a part of. We see this very often in both crowdfunding as well as public markets. For example, when you go to a campaign and it's raised 200-300% of its goal, In a perks-based campaign, you tend to believe there's a lot of traction, there's a lot of reason to why somebody's giving, and you want to be part of that movement. The same holds true for public markets. It's the reason why on the day they can go up or down well in excess of any kind of financial news that might be out there. It has to do with the herd mentality behavior of people. And this holds true for VCs. There's rounds that get oversubscribed because once a specific kind of lead investors in or a specific amount of money has been raised, and everybody, while this shouldn't happen, because they're supposed to professionally delineate themselves from that behavior, people then try to jump in and participate. The third reason is product. It's very simply put, you spend money and you get something in return. It's the reason why you might have originally purchased a Pebble watch, or not purchased, but funded a Pebble watch on Kickstarter. It's the same reason why you walk into a Bed Bath & Beyond and give money for a coffee machine. You're exchanging funds and you're getting something in return. And then the last reason is the actual return on investment. This holds true whenever you're giving money and you're hoping for something in return that's in excess of the original amount you gave. What is interesting, though, is the return is deliberately put at the end because it's the least powerful motivator to why people provide funds. Now, for venture capitalists, their mandate is the return side, but the qualifiers they look at is the person, the movement, and the product. While with crowdfunding, the reason why people tend to get involved originally is less the return and more the person, the movement, the product. So what that does is it changes the behaviors around how we do stuff. So that's why when we're talking about does this change the priorities, like what is important and what is not, like do we have to move these things around? And one of the interesting things is not really. So when you're talking to a venture fund, they are very much interested in the return, but those other things are the qualifiers for them. While with crowdfunding, the first three things are exactly what crowdfunding qualifies, right? It kind of demonstrates a market. So I want to first show kind of how crowdfunding can happen before a venture raise. So one of the things that happens when you're starting a crowdfunding campaign is you're in essence, if you're successful, you're proving out, let's say, the demand for what it is you're doing. You could say, I've built a new consumer product, and I was able to raise, let's say, $2 to $3 million online, and it shows that I know how to communicate about my product, I know how to execute on my marketing, and I know how to demonstrate, for example, demand for what I'm doing. A good example of this is a bicycle helmet called Park and Diamond. It looks like a baseball cap. They raised several million on Indiegogo, and then subsequently they went into an accelerator in Greenpoint, Brooklyn. But what they did was they proved out that there was a market that was willing to tolerate the price point of what they were doing. So from a venture perspective, what crowdfunding on the perks side does, and specifically perks, is it's an exercise in risk mitigation, for better or for worse. Let's say we're evaluating a company and we don't necessarily know if there's a true demand for this. If the company came to us and they said, we raised $3, $4, $5 million through perks-based crowdfunding, then we know they were able to demonstrate demand for their product or service. They know how to communicate about it in the right way, which has to do with the business development skills of the company, and they know how to execute in regards to their business. But what's very, very appealing is structure. So with a perks-based campaign, there's no equity give by a business. There's no dilution that occurs. There's no unknown investors on the cap table, which makes it a much more attractive investment for the venture side, because we don't have to deal with unknowns or uncertainties, and the founders at the same time have protected more of their company ownership. Now, this is only true for perks-based crowdfunding, so I am going to talk about the equity side as well, because that's where there's a lot more nuance, a lot more complexity. So then when we're looking at the equity crowdfunding space, one of the things we've noticed is equity campaigns sometimes run in parallel to venture rounds. So it would happen that a company lists online and they, let's say, are raising some form of capital that they want to give to the public markets. At the same time, they're also raising a venture round. The question that comes into play here is how the failure of one can affect the other. It's basically running two train tracks into the same tunnel, and there's risk with that because this is where it starts getting a little bit more complicated. They tend to be different types of shares. And what that means is they tend to be different types of rights, different types of ownerships, and that can really change the behavior of the investor base. Us as a venture group would not, for example, want, to put it bluntly, 500 to 1,000 people or more having voting rights into a company, because that can prevent in later rounds a company of securing, let's say, all the votes from different people. You might have to chase someone for a $500 investment. That's stuff that we would never want to see. So what gets pushed for is different share classes and types. So that means that you have, let's say, a crowdfunding share for your company and you have a venture share for your company. It changes the type of campaign. But what we've also seen happen is a perks-based campaign runs in parallel to a crowdfunding campaign. This actually happens a lot, and it happens a lot quicker. A company might have started raising money on a crowdfunding platform. They hit a massive milestone of some kind, raising a lot of money, and they start getting approached by venture groups. The venture groups are providing equity capital, while the crowdfunding campaign is basically providing working capital in the form of a pre-sale product to allow the company to actually execute on delivery what it is that they're doing. But there is this very kind of tricky thing here because the incentives are different. So let's say we're doing an equity crowdfunding campaign. There's different kind of stakeholders and there's different kind of goals. So if we remember what I was talking about earlier, the reasons to why people are giving funding of any kind, sometimes it could be that they want to invest in their local brewery and they want to own a small percentage of it. There might not be fully looking for the same kinds of returns that venture capital is looking for. They might be motivated by the different access that they get due to their share class. And they might be looking at the business at a completely different capacity. So when a venture fund is, let's say, investing in a company, they need to look at the potential of the business. How much is it a lifestyle company versus something that can provide a return to investors? And because of that, the incentive structures and the goals that are present are different. So what we're talking about here is two different types of stakeholders, and that could change the motives and what happens. So one of the things to keep in mind is if you're raising funds, you're the one consistency. So the choices that you make are what actually matters. This is most true in angel rounds. So the early rounds of a business, most venture groups don't necessarily participate in that space. Angels are those who very, very strongly believe in the person or the idea or the concept. The angels could be close friends and family members, those with financial resources. Interesting enough, that is the exact same group that tends to be the first participants in the crowdfunding project. So one of the interesting things about that is if we go back to prior to the Jobs Act, early venture rounds were, for lack of better words, very sloppy. Early angel rounds are very, very sloppy. And you would have basically like the IOUs to Uncle Nico that was just on a piece of paper. You don't even know if this investor was allowed to make the investment. You didn't know how the company was structured. And what we're having now is a framework by which a company can raise funds as their first investment early on in a structured and cohesive manner that makes it more likely that a venture fund can look at a business and not be scared off by, let's say, the structural issues of the company or the compliance concerns that may arise. So there is this, and it's funny because very few people talk about that, but it's a massive benefit, a massive incentive to what is happening. So one of the things to keep in mind is if you're running, let's say, a venture that you believe is venture backable, but you're still very early and you're doing the idea stage, and let's just say it's not a consumer product, so you can't do pre-sales, doing an equity crowdfunding campaign in order to onboard the right types of investors, the right types of structures, and doing it in a compliant fashion will or should help in what you're going to be doing moving forward in regards to your campaign. So keeping that in mind, we kind of need to, for lack of better words, make sense of it all. We need to figure out, how do we do this? Well, it's all about managing expectations, and that's the one thing to keep in mind. When you're raising capital, you're in essence growing your business with other people's money, and this is a very, very big deal. This is such a big deal that the right kind of person will treat that money more closely than their own capital. You for example might be willing to take a certain kind of risk, but the person who gave you the money is not, right? And this is true also for us as a venture fund. We as a venture fund, and all venture funds, operate with somebody else's money, right? We're not necessarily the ones providing that capital. We have what's called limited partners who provide us money in order to invest it on their behalf. And because of that, we have to always think, are we doing a service to that investor? When we're investing in a company, can we justify it? Are we providing the value, the opportunity to them? This holds true for you raising funding for your business as well. Once you take on investment where they have an ownership position in your company and their benefit is closely tied to the performance of your business, you need to start managing the expectations of how you operate, what you can do, and what are the risks that are involved in it. And can you communicate them properly? And what is a little bit interesting about this is for most equity crowdfunding campaigns, the terms and structure are set up by the company. And then the people investing tend to accept those terms or not. There's very little back and forth. There's very little structural components to it or negotiation. That almost never happens in the venture capital space. There almost never do we see a company setting terms and then professional investors just accept them. It does occur, but it's exceptionally rare. And the reason is from the venture space, we also look at other aspects for future investments, future rounds, the growth of a business and what that can look like. And there's a certain level of professional expertise that lends itself to making those kinds of assessments. One of the more important things when it comes to the structure and opportunity of equity crowdfunding is the investor class doesn't necessarily look at it the same way, and they may not fully comprehend how further growth in the company may affect their position. For example, one of the biggest points of feedback we've heard of when surveying the market, when let's say we make an investment in the company that did an earlier equity crowdfunding round, is those investors have poor comprehension, not to their fault, of dilution. They said, oh, I invested in the company and I bought, I thought it was 0.5%. How is it that this round is going to now cause me to only have 0.25%? That's wrong. I'm not okay with this. And depending on how it's structured, that could become a real problem. It's a real issue. So one of the things we've seen in the venture space that has not yet manifested in the equity crowdfunding space is the idea of a common set of documents. So real quick, you have an example of a company that decided not to raise venture funds. They went solo. They raised $441,000, never took any kind of an equity round whatsoever, sold at Williams-Sonoma, Home Depot, and their native store. You have the example of Kinza. They raised $138,000 through Perks crowdfunding. Then they raised, because they demonstrated the market, they raised $9.6 million Series A, and then a subsequent $17 million Series B. But prior to the Perks campaign, they raised a small seed round from angels and early VCs. Then this is one that I think we're more familiar with. It's bank called Monzo out of Great Britain. They did a $20 million equity crowdfunding round for just shy of 1,900 people at a $30 million valuation. They raised subsequently $304 million from venture so far, and they're anticipating a new round right now at $1.9 billion valuation that puts at a 63x increase from that original valuation. But we don't know the structure. We don't know how the equity crowdfunding campaign was put together, so we don't actually know how it looks. So I'm going to be wrapping this up, but one of the things that's important is the uniqueness of each side. So crowdfunding is PR media, community validation, loyalty. Let's say a perks campaign is one thing, but an investor is someone who, if you're, let's say, a coffee shop and you're doing an equity campaign for your business, or an ice cream store, they'll come every day to drink your coffee. They want to see your business do well. They're going to drive in new customers. There's a lot of flexibility there. On the venture side, the value is more the mentorship, the strategy from the professionals you're raising money from, their experience in business development, and also their ability to help you raise future rounds of capital and grow it. So doing that quick takeaway, the real strong trend that we've noticed between venture and equity crowdfunding is the more niche and complicated the industry is, the less relevant the power of the crowd becomes. And that has to, and this is like so true, and it's a very simple, but it's a fundamental. We all understand what it is like to, let's say, invest in a brewery. We understand beer. We know how to drink it. We know what it tastes like. We get it. But if it's, let's say, a pharmaceutical research company trying to look at, some kind of new molecule, I don't know what that's about. I don't have that expertise. It resonates less with a crowd. So real quick, one of the things we've noticed, and then we'll turn it over to discussion, is consumer products tend to do very well in crowdfunding markets. A beer does well, a hat does well, a new type of the Pebble watch did well, and they raise subsequent venture funding. It's things that people understand and can kind of grasp. Some founders that were ignored by venture capital tended to succeed with equity crowdfunding. One of the platforms actually reported in 2018, 25% of investments went to founders of color, 44% of investments went to companies with a female founder. For that year as an industry venture, it was 1 and 13% respectively. So sometimes what we're seeing is kind of, I don't want to say the word disruption, but a challenge of a status quo that is often grounded in poor fundamentals. And what we're now seeing is sometimes new ideas and concepts that may not be venture backable emerge as equity crowdfunding backable. So giving a quick run through, we figured the rest of the time we'll leave it open to discussion.
Alon, that was great. Let me just ask you, you've just given us so much to think about, but it seems like there's kind of a relatively, and if you want to just turn your share off so people can see you answer these questions, that might be good. But there are three distinct, well, four things you talked about. And
yep.
One is perks-based crowdfunding. You talked about equity crowdfunding, where you're selling securities. You talked about angel investments, and you talked about venture capital, of course.
Yes.
And the whole discussion is how those all interrelate. But one of the things that I think you didn't touch on was the fact that it seems like some investments, some entrepreneurs want venture capital, but their business will never be worthy of venture capital. Isn't that a dynamic that you see a lot?
Yeah, it's a very interesting point you're actually making, Devin. Is there is such a thing as non-venture backable businesses that they just don't have, let's say, the ability to provide the kind of return a venture fund needs in order to mitigate the risk they take in all of their investments.
But they may be able to attract crowdfunding, equity crowdfunding, right?
Yes, exactly, and that is 100% true. So while they might not, let's say, be relevant for venture, the equity crowdfunding market has different motivations and criteria as to why they choose to invest. And this is a true thing. On my block, there's an ice cream shop right now. They're doing an equity crowdfunding raise. I don't know why people are there in the winter, but nonetheless, they're raising funds. There is no way that local store would ever be able to raise money from a venture group. It's just not. They're a retail store. They don't have like large-scale chain potential or anything of that nature. They're just going to be the shop that they are. But they are raising about $1 million, $1.5 million from people within their community who want to feel like they have a piece of ownership in the business.
That's huge. That's huge. You know, so many businesses can survive just by raising 100,000, and $1 million is a lot for a lot of small businesses. So that's exciting. Alon, we had a question from Clayton, who's participating in the discussion, watching today, and we're thrilled to have you, Clayton. Thanks for joining us. He asks, can you address in crowdfunding the breakdown between equity and debt?
Yes. Okay, so I'm trying. Let me see how I can put it in concrete terms. So this will hold true, by the way, for equity crowdfunding as well as just standard investments. But equity and debt are two different kinds of vehicles, right? So when you are, let's say, giving someone $100 in return, you own a fixed amount of shares in the business, that is considered to be, you're holding equity in the company. So you're holding a set amount of ownership. When it comes to debt structures, it is technically considered a loan. And when capital going out is considered a loan, it gets treated differently by the business. There might be interest rates attached to it. There might be payback periods attached to it. But the initial investment is cash that is considered to be a debt. So when you're doing a debt financing, though, for let's say a crowdfunding campaign, what you're actually most typically seeing is something called convertible debt. And what that is that initial loan that you made will have in the future the potential to convert into an equity position, which is ownership. But very often early on in a business, they don't yet know what the value is of a company. They don't yet know who is able to price it or how to make it work. So what they do instead is they take on this debt that might have, let's say, benefits to conversion, like some kind of a discount. So if I gave you $100, I'm really getting $120 worth of your business in the future against some kind of a value. But the structure allows you to do debt-based crowdfunding, in this case, in order to own a future equity position. I'm not talking here about issuing out loans, which is something like Kiva does, where you like a business, and that is also crowdfunding, by the way, where you're doing debt crowdfunding and you like a business and you're willing to issue out a small loan in order to make that work. It's the same for the Lending Club and it's the same for Prosper. Those are straight loans that are debt-based. But when we're talking about business crowdfunding, in the equity crowdfunding space, those debts are typically convertible to shares in the future.
Now, occasionally you will see some people using royalty-based loans as a funding mechanism, and there is no conversion option. But you're not seeing that very often. I'm taking it from your reaction to that question. You're not seeing that a lot.
No, you're not. And that the royalty thing is typically also reserved for very specific types of industries, usually where there is a recurring revenue stream in the future that has, let's say, content attached to it or events. You've seen in the past musicians and artists raise funds in this manner to, let's say, put out a new album and share in on the royalties that might come from it. For film financing, this could be very interesting as well. But usually what is being done for is the creation of a product or a service that is defined as a sequence of events that generate revenue that allows you to actually earn royalty on it. The real issue is you're investing in something that you may not fully comprehend. Like, we don't know, most of us don't know the business mechanics of film financing, or let's say a musician going on tour and how that works. And there's a lot of nuance to that space as well. So sometimes you want to keep it as simple as possible so that all parties involved understand what it is they're investing into.
Oh, fantastic. Well, Alon, it's been great to have you. It's just a thrill to have a chance to download some of your wisdom on this topic. We really appreciate you. For those who are watching, of course, we'll leave this up on Facebook where most of you watched. We'll also post this on YouTube and load that onto the Crowdfunding Professional Association website. So check us out there. We really appreciate everybody joining us today, and thank you very, very much for coming. It's been a great, great discussion. So thank you.
Thanks, Devin. Thanks, everyone.
All righty. Bye now.
Bye-bye.